Palantir is changing early investors' life. I mean, this is a stock that roughly the past 2.5 years, the stock price is up a shocking 2,546% over the past 2.5 years, roughly, right? I mean, that's more than a lot of people make in a lifetime of investing in the S&P 500. Like if you get in, let's say you start actually taking investing serious in your 30s or 40s, right? By the time you're actually retirement age, you probably still won't have made 2,500%. Like that's just such a ridiculous amount. Such a ridiculous amount. I mean, look at the S&P 500 over this time. The S&P 500 has done very well over the past 2.5 years, roughly. S&P 500 is up 66%. But it just is nothing, literally nothing. It's a rounding error when you compare it to a 2,500+% gain in Palantir. So congratulations to everybody's been along this ride for, right? I wanted to pull up a 25-year chart because I was like, how far back do we need to go to see us making 2,500% in the S&P 500, right? So I took it back 25 years at first, and I still wasn't even in the same ballpark. If you invest in S&P 500 25 years ago, you would have a return of 357%. 357% in 25 years. Now you can say, well, you know, you receive a little dividend money along the road, so the return's a little better than that. Sure. Okay. It's still horrible. Okay, that's not good. Like 357%. Like, oh my gosh, like I wouldn't be shocked. I mean, shoot, 25 years? I mean, heck, housing prices have gone up. It seems like almost that much in some markets. I mean, like if I think back to how much a home costs, like I remember my parents sold their home. It was in a real bad community we lived in. They sold it in 2001. We moved to like a middle class community, but I remember them selling that home for a little over $100,000. And I think that same house today is valued by Zillow at like, I want to say like $350,000 or something like that. Like, you know, and I'm sure the community's still as bad as it ever was, but that's just crazy. And so you only made 357% in 25 years. Now check this out. This is insane. Absolutely insane. 1986. That's how long ago you would have had to buy the S&P 500 to have made 2,500%. 1986, folks. Think about this for a moment. Let me take you back to 1986, okay? Ronald Reagan was the president of the United States. Mark Zuckerberg was 2 years old. 1986, Starbucks had 6 locations. 6 locations Starbucks had. That was 7 years before NVIDIA was founded. 7 years before NVIDIA was founded. How insane is that? That's how long. So when somebody asks, why do you do this individual stock picking? Why do you want to, research companies and pick your own portfolio and things like that? Why not just put in an index fund? Show them that. Show them that sometimes. And they'll begin to realize, oh. And then they'll say something like, well, that's just a one-off situation. Like, you can never have success. Just look at me. Look at how many stocks I've had that have been absolute bangers over the years. From Tesla to Elf to Meta to Palantir to SoFi to Amazon, right? NVIDIA, if I would have just held it and not sold after I made a little profit. I mean, we could just go down the list of like this. I'm just one guy. I'm just one guy. And there's been plenty of stocks over my investing life that I missed. Plenty. There's plenty of stocks that are up thousands of percent or even tens of thousands of percent since I got in the market in 08, 09, right? That I didn't get it, I didn't know about the company, or I looked into it and I just couldn't formulate it, and I missed them. And yet still look at all the success. Look at all the stocks I've gotten right. Look at all the money I've made. And it's like, I'm just one guy out here who missed it. I've missed way more stocks than I've gotten right? Like, think about how many stocks there are that have made thousands of percent or tens of thousands of percent since I got in the market. And think about how many I made huge amounts of money on, right? Like, when you think about it like that, it's like, geez, there were so many other opportunities out there that I didn't even get. So when people come up to you, it's about building a great portfolio of 10, 20 stocks, and you can get a few of these that are the game changers, your portfolio in your life is changed financially forever. Not like, it's changed forever. because you'll make what people hope to make in 30 or 40 years in an index fund. You can make that in a matter of a few years. You play this game on a high level, man. You know what you're doing. You put in the work. You put in the research work. It's unbelievable. Unbelievable, right? No, even in the past year, you could have, if you invested in Palantir a year ago, this time, right? You could have said, I missed the move, right? Stock's already 30 plus, like I missed it, right? Stock was $6, $7, I missed it. Even since a year ago, you still made 448%, which is just a shocking move. Remember, 448%. And remember I showed you a 25-year chart of the S&P 500? 25-year chart of the S&P 500 is up 357%. You made more just in Palantir in the past move after you missed the big move, right? From $6 to $30+. Even after you missed that, you still made way more in the past year than you would have made in 25 years holding the S&P 500. That's unbelievable. Unbelievable, right? Now, big upgrade happens here today. Palantir gets a buy call despite valuation. The stock is a secular winner. What's going on here? For all the talk about lofty valuation of Palantir stock, backers of the artificial intelligence heavyweight aren't backing down. In fact, they got reinforcements on Friday. Piper Sandler's analyst initiated coverage of the stock, rating it overweight with a price target of $170. Wow, interesting, a $170 price target. Piper Sandler has monitored the stock since before its direct listing in 2020 through late 2022 when it plummeted to $6 and into 2025. Quote, where Palantir has been crowned an all-star on accelerating growth. Interesting, end quote. He sees Palantir as a secular winner in the AI revolution, saying multiple factors will usher in growth of more than 30%. Technically, they already have way more than 30% growth. They're clipping right now around 40% roughly, with free cash flow margins of above 40%. Government contracts are part of that. The analyst expects the company to deepen its ties to the Army and Department of Defense, at DoD, gaining from shifts in military spending that will benefit AI software providers. Closer connections with Fannie Mae are also likely, he says. While Palantir is most often linked with the U.S. government, its commercial division has grown. The analyst believes U.S. commercial revenue could expand at 33% compounding annual growth rate to $5 billion by the end of calendar year 2030. Do I think that's possible? Very possible. Very possible. Like, yeah, 100%, like, no doubt in my mind. Both as more companies use the company and as a result do partnerships with Accenture, Databricks, and SAP. Now, the analyst noted, this is interesting here, very interesting. The analyst noted that visitor traffic to the company's website surged 144% in the second quarter, up from 62% last year. That reinforces Palantir's status as an industry leader akin to Anthropic, ChatGPT, and CoreWeave, all which have seen comparable growth, the analyst says. All that hasn't gone unnoticed. The share price has more than doubled this year. Anyone who wants to invest in the company will have to pay up. As of Thursday, Palantir's stock was selling for more than 232 times the earnings per share expected for the next 12 months, compared with 22 times for the S&P 500, right? So you're basically paying a 10x valuation. The question is, can Palantir grow 10x an average company in the S&P 500, not only for the next year, but let's talk about the next, decade. That's really the question, right? One reason is that the AI boom has sparked extraordinary interest in Palantir. A Reddit community dedicated to discussing the company has 106,000 members. Many investors reason that Palantir will keep rising as business and government contracts continue to pour in money into AI. The analyst's view is that valuation at present is unsustainably high. Palantir's valuation premium leaves little margin for error, particularly in any warning signs of moderating growth emerges, he wrote. Still, he believes the stock is worth buying, suggesting investors load up on it when the price falls. He cited 12 times shares have slid by 20% to 29% in the past 5 years, right? So, basically saying buy the dip, you get those buying opportunities there, which is very, very interesting that he's saying that, right? Now, the main thing that you got to keep in mind when it comes to, like let's say you make game-changing money on stock, right? You make a ton of money, you made life-changing money on a stock, right? I was showing this in my private stock group here today. This is the P&L calculated by Fidelity Investments of the public count so far this year. Taking $606,000 of gains. $606,000 of gains, right? By far and away the best year in the history of the public count in terms of taking gains, right? My view is you buy quality, not high risk. When you make crazy money on a stock like Palantir, right? And this could be for any stock. You make life-changing money, you make insane gains, thousands of % gains, right? You don't want to take insane risk with that money. And, what got you to that place is not going to be what gets you to the next place. And the thing you got to understand, especially when it comes to me and finding some of these stocks, I take lower amounts of risk. If you look at Palantir and me buying my Palantir position, it's not like I risked the farm in that stock. I took a very, very calculated amount, not a crazy amount. If Palantir went to zero, it wasn't like an amount that I'm going to be on the street like asking for change, right? I put a modest amount in and made ridiculous sums of money across my accounts in Palantir. Unbelievable, right? And so when you make that game-changing money in a stock, just don't blow it, man. Just don't blow it. Because a lot of people, what happens, they make that game-changing money and then they want to feel that high of making the next 2,000% gain stock. It might take a while before you find that next one. And when I say a while, it could take you months, it could take you years to find that next 2,000% gain type opportunity. So don't get impatient with it and start, just trying to, some crazy quantum computing company over here, maybe they're the next 2,000% gain. So let me buy that one. That's how you screw up all your gains there, right? Because the next one doesn't quite go like the last one went. And so you got to make sure you buy quality companies with that money, not super high risk and screw the whole game up, right? Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with. Fubo, next up here. Fubo. So this stock's moving for us. This stock should have been up 20% plus today. Do not be surprised at all if you continue to see Fubo momentum in the stock for the remainder of this week. Don't be surprised if the stock goes $4 plus this week. Something fishy is going on with the share price today. I don't know, because Fubo, and we're going to get into the numbers, they came out with like shocking results out of nowhere. No one was expecting it. And it looks to me like some sort, I don't know what's going on, some sort of manipulation, in my opinion, is going on today with the stock price. Maybe people got caught off sides by this, so they're trying to manipulate it down to get out of some put positions and get into some calls or something. But just watch the stock. If you see the stock go $4 plus this week, there's no doubt in my mind somebody's doing something fishy. They got caught way off sides, and they're like, man, I need to get the stock price down. And, here today, get out of some puts, flow that into calls, and then roll. Like, there's definitely some fishy stuff going on. I've been in this market, almost 17 years now. I've seen plenty of fishy stuff going on. So just remember, if Fubo goes $4 plus this week, do not be surprised at all, okay? So what's going on with Fubo? So they announced preliminary, they just come out of nowhere, preliminary Q2 results. Now, whenever a company preliminary announces results, they're usually either really great or really disastrous. It's one of the two. They don't usually do that. This is not a normal thing, okay? Company's global streaming business expects to exceed revenue and subscriber growth. What's going on here, okay? Well, the North America revenue for this quarter, they're about to report, they're expecting it to exceed $365 million. The prior guidance was for $345 at the midpoint. So they're over, $20 million at least ahead of midpoint. Makes sense to come out with a preliminary number like this, right? Paid subscribers expected to exceed 1.35 million. The prior guidance at the midpoint was 1.24 million subscribers. Whoa. Huge influx in subscribers for Fubo. Like, wow. Now, in terms of Fubo's revenue, that's going to mean way better things for Fubo's revenue over the next few quarters. Because remember, when a subscriber subscribes to Fubo, they could be on a free trial at first, or they could be, they're just like going to have one quarter or like 1 month of payments, right? And a lot of people, when they sign up for Fubo, like I've been signed up for Fubo for years. I think I pay $99 a month for Fubo, somewhere around there, right? Because I like to watch a lot of college football, and Fubo's got like the best lineup for college football. They have almost every channel imaginable for college football, right? That's like my big thing I like to watch. So I end up staying signed up for Fubo all year round, and I think I pay them $99 a month, and I got like the highest tier package or whatever, right? But for that first month when I sign up for Fubo, it's not like they make a bunch of money off me right there. They only make, let's say $99 is only in that quarter, or maybe three $99 payments are in there. But it's about what they make over the next many years from me, right? So that came in good. Rest of world business doesn't really matter that much for them because it's such an insignificant number, but their revenue came in they're talking about revenue exceeding 8.5 mil versus 7 mil, subscribers exceeding 340,000 versus 330, but that rest of world business is kind of a joke. I would actually prefer Fubo just to sell off the rest of the world business and just focus on North America, right? Now, second quarter net loss is expected to be approximately $8 million. That's like nothing. It wasn't that long ago Fubo was experiencing net losses of like $100 million. Like, it was ridiculous, the net losses this company had a few years ago. An improvement of approximately $18 million on a year-over-year basis. They're getting really close to true profitability. Adjusted EBITDA is expected to be at least $20 million positive. Positive, folks. An increase of at least $30 million year over year, which would represent Fubo's first quarter of positive adjusted EBITDA. Oh my gosh. Like, I put tear falls here because it's just like, it's been a long time coming, man. And that we're actually here. Company's going to report a positive adjusted EBITDA quarter. And you know what happens right after positive adjusted EBITDA? Profits on the bottom line. Ask Palantir. Palantir went positive adjusted EBITDA and then flipped over the other side. That happened to SoFi as well, right? The company is also expected to end the quarter with at least $285 million of cash equivalents, and restricted cash. I mean, this is only a $1 billion something company. 285 mil of cash and cash equivalents, and now getting ready to flip over to profitability? Let's freaking go, man. Unbelievable. Now, here's where things get really big. You gotta, if you know type situation, okay? And let me explain what's going on here. Look at this. The company is pleased with its preliminary second quarter results, including year-over-year improvement in net loss and achievement of positive adjusted EBITDA. At this time, Fubo will pause providing guidance of future results while the proposed business combination of Hulu plus live TV is pending. The company remains committed to operating its business to align with long-term value creation in the best interest of its shareholders. Fubo recognizes the need to retain flexibility during this period leading up to an anticipated business combination. As a result, Fubo is withdrawing its previously communicated 2025 profitability target and pausing providing subscriber and revenue guidance. Okay, this is big. Listen, Fubo can't really comment on where this is at in the process for legal reasons, right? And they don't want to do anything to screw up this potential deal. I mean, this is a deal that involves Disney. Remember, Disney owns Hulu, right? You don't want to do anything to mess this up. So they've got to kind of stay quiet on this. But this is one of those like wink situations, like if you know, you know. Here's the deal, okay? What do we know about Fubo's business model factually? We know it's going way better than anticipated. There's only two reasons you would take away providing guidance in the short term. One is your business results are horrible. Is that what's going on with Fubo? Absolutely not. It's going way better than anticipated. So it's not that. So it has to be for another reason. The only other reason is because a deal is about to get finalized very soon here. And so there's no point in putting out a guide right now because this deal's going to go through soon. And how you can communicate that the deal's likely going to go through here pretty soon without saying that is by taking away the guidance. Been doing this for a long time. You got to put the pieces together a little bit here, okay? So, moral of the story is here. Fubo freaking looking amazing. Listen, I would not be shocked at all if this stock's $5 plus after the deal goes through. And I don't know when we're going to hear about that deal going through. Maybe it's a month from now. Maybe it's a week from now. Maybe it's 3 months from now. But my guess is it's sooner rather than later, and the stock's likely going to be $5 plus after that deal, right? I wouldn't be surprised if it climbs substantially into the deal. Additionally, don't be surprised if the stock goes $10 plus in 2026. Now, when it comes to long-term opportunity here for Fubo, I always like to comp Fubo against Dish Network back in the day. Now, Dish Network's prime of their business model was really in the 2000s and into the 2010s, right? And Dish Network would make they would throw off $1 billion plus of earnings a year. It was incredible, right? Some years even up to $2 billion. Now, Dish Network had a tough business model in the respect of they had satellite dishes. And if you ever had Dish Network or DirecTV back in the day, you know what I'm talking about, right? A guy had to come out, install the satellite dish on your house and get it all like signaled right in the perfect spot. And then he had to do all the wiring and drill holes in your house so the wiring could come in. Then you had this expensive like DVR box in your house as well, right, or your apartment. And you had to have all this set up, and the guy would have to make sure all the channels were good and all this stuff. It's a complicated process. And that's very expensive to do that, right? Fubo doesn't have to deal with any of that. Fubo doesn't have to deal with all that complication. If somebody wants Fubo, they can get it right now in the next minute. They don't need to wait a few days or a few weeks for some guy to come out and then try to put it in the satellite dish and do all that and all that cost that's associated with that, right? Maybe the person changed their mind. They're like, you know what, now I don't want satellite. I've signed up for cable instead or something like that. Somebody wants to sign up for Fubo, they can literally do it in the next minute if they want, right? And boom, you got it. Boom, you can watch it on your TV, watch it on your phone, watch it on your tablet. It's so much more of an efficient process than Dish Network used to have, than DirecTV used to have, all those guys back in the day, right? That had those great business models that were producing, $1 billion plus a year in earnings. So what I believe is going to end up happening for Fubo over time is they're going to become a business that does $1 billion plus a year in net income, right? Probably in the next 10 years. And if they do that, you could throw a 30 PE on there, right? Assuming the company still has strong growth at that time. Remember, the market trades in general around a 20-ish PE. So a 30 PE is if the company's growing 50% faster than an average company, which let's say an average company's growing like 4% revenues. If Fubo's growing 6% revenues, right? Then you can say it's 50% more, or 9% revenues or something like that, which is not crazy for Fubo at that time. You could throw a $30 billion market cap on this in 10 years, right? Or whenever they reach that $1 billion a year milestone in net income. Market cap's a little over $1 billion right now. I mean, it's just so much upside here that's ridiculous. And Fubo's so de-risked compared to where it was a few years ago. If I take you back to Fubo a couple years ago, Fubo was starting to run very low on cash. They were taking massive losses, and they had a big fight with Disney, right? That's been removed. Now they're getting in bed with Disney, which Disney's very powerful. You've got to have a great relationship with Disney. They're very powerful. They own ESPN and a ton of networks that are like the SEC network and a ton of other networks that are associated. So if you want to be a big player in sports, you better have a strong relationship with ESPN. And then there's also a lot of reports that Disney through ESPN wants to buy NFL Network, or at least a chunk of NFL Network as well. So all I'm saying is like you got to have a healthy relationship there, or you're going to end up in trouble, right? And so they're getting more into bed with Disney now. Certainly, in a lot of ways, right? Which I think should bode well for them over time, right? And so I like what I see here across the board from this Fubo situation. So yeah, man, Fubo, what an opportunity. Like I said, don't be surprised. If that stock goes 4+ this week, I will be 0% surprised. Like, the stock should be up 20+% today. Based upon what I just took you through, it should be a 20% plus mover today. If not a 30% mover, given how strong those numbers were, given the wink situation, the stock should be 4+ right now, and is not. But don't be surprised if they move that baby, right?